So, well, there is little certainty right now about Omicron. If nothing else, that could spell a period of high volatility as investors try to second guess the real risks from the new coronavirus variant. Already positive scenarios built into many forecasts for global growth are being revisited. It could be a blow to hopes that the world economy will enter next year on a firmer footing. Well, new travel restrictions are already shaking confidence ahead of the holiday season. And what comes next will be determined by what scientists discover, including how resistant it is to vaccines and how transmissible it is. A worst-case scenario, a return to growth-crippling lockdowns, which would damage recovering demand. Now, that would reignite fears for worsening stagflation, which is faster inflation and even slower growth. Paul Gambles from MBMG Group joins us now. Paul, well, what are the next variables or indicators that you're looking for in determining the extent of the economic impact of Omicron?
Yeah, so I think you just set the scene really well there, Elizabeth. I think that sums up all the issues that we really are sort of facing uncertainty. The problem is, we've been facing uncertainty for a while, but markets have been kind of blinded to that, and that means that we've got asset prices that are so high they really don't recognise the risk that's in there. It's not priced in at all. I mean, it's interesting. This is Omicron. This is a Greek 15th letter of the Greek alphabet, which as far as the World Health Organization are concerned, presumably means they hope there's only another 9 variants to go because there's only 9 more letters of the Greek alphabet that they haven't used. But to us, it sort of reminds us of the fact that human beings throughout history have been really bad at pricing risk, and that's what we're seeing here. And so I think all the risk really is pretty much to the downside at the moment, that things are not going to be as good. And it's not necessarily just because of Omicron. There's an awful lot of things that are happening in the world. We're getting ramped up geopolitical tension. We've got a much less helpful policy backdrop going on at the moment. We've actually got negative liquidity going into US markets at the moment from policymakers. So you add all of those things together, Omicron could just be the kind of straw that breaks the camel's back. In itself, it doesn't have to be that significant. It's just a pointer to a fact that markets are getting a wake-up call, and maybe they needed it.
Yeah, and Paul, so many forecasts are predicted on there being no impactful new variant emerging. So with Omicron in the picture, what are the worst and best case scenarios should economies be reevaluating their growth trajectories?
Oh, they totally should. I mean, everything was priced for perfection. All these growth trajectories and all these models that you're talking about, all the forecasts, they were all very, very much priced for perfection. So absolutely, we needed to evaluate those because we're not living in a perfect world. And Omicron is just the latest reminder of that. The things that we're looking at is we're looking at how severe the impact of Fed tapering is. And at the moment, as I say, it looks like we're going to have the first negative month in terms of government-produced liquidity for markets. If that continues happening, that's going to take away the impetus for higher price earnings ratios. So you've got to look at PEs, which are going to be driven by that. But also, you've got to look at the effect on the real economy as well. And the recovery was very fragile. It certainly wasn't a robust recovery. People were looking at year-on-year numbers. Well, now they're going to have a higher year-on-year base to look back to as well. You look at US manufacturing hours worked. All of these things that shows that the real economy is in a bad state, as well as the fact that the capital markets are also, overpriced and not going to get the support that they've been having that have driven them to those levels. So, on one hand, look at the capital market factors, look at primarily at liquidity. On the other hand, look at the real economy, look at things like, I say, manufacturing hours earned in the States, and that is at its weakest level in 2021.
Well, at the same time, we want to look at the China effect. What will it mean for global growth? Should Beijing double down on its zero COVID approach?
Yeah, and again, that's another great question. there are two aspects. Obviously, one is what that does to the real economy, but also, I think there's a lot of complacency about going back to this issue of U.S. policy taking liquidity out of the markets instead of putting liquidity into the markets. When that last happened, 2015, we had a pretty severe market reaction, but then it all got smoothed over by the fact that China and the EU stepped up and started replacing the deficit from the Fed taper. Well, this time, I think, one consequence that's not really spoken about of Chinese policy is that I don't think they're going to be rushing to pour money into the global economy in the same way that they did in 2015. I don't think the EU is in the way it's able to support global economy in the same way that it was able to in 2015. So yes, China kind of closing itself off again is a worry from an economic point of view, but it's also a massive worry from a capital market point of view too.
Well, thank you, Paul Gambles, MBMG Group.